Silver collapsed when the world was asleep. In the quiet vacuum of the Asian trading session, during the thinnest liquidity window of the entire day, the price of silver didn't drift lower, it was violently forced down. In just minutes, billions in paper value vanished, not because demand disappeared, not because new supply was discovered, but because a mechanical liquidation cascade was triggered with surgical precision. This wasn't panic selling. It was an execution. A message sent in the dark, aimed directly at those who believed silver had finally broken free. The charts from that moment look unnatural, almost lifeless. At the exact time silver was being smashed, physical inventories across global exchanges were near historic lows. Industrial demand was surging, especially from solar energy, electric vehicles, and advanced electronics. Every real-world signal pointed up, and yet an enormous volume of paper-silver claims on metal that does not physically exist was dumped onto the futures market in seconds. The volume exceeded what major silver-producing nations mine in an entire year. That alone tells you this had nothing to do with real metal changing hands. This is the uncomfortable truth most people never hear. The price of silver is not discovered by supply and demand for the physical metal. It is dictated by a leveraged paper system designed to prevent silver from acting like money. What happened overnight was not a correction. It was a defense mechanism. A system under stress lashing out to protect itself from a metal that exposes monetary weakness simply by rising. This war against silver is not new. It stretches back more than a century to the moment silver was deliberately stripped of its monetary role. When silver was demonetized in the late 19th century, it collapsed the money supply, devastated the working population, and consolidated power into the hands of financial elites. That playbook never disappeared, evolved. Today, demonetization doesn't happen through law alone. It happens through derivatives, algorithms, and rule changes disguised as market mechanics. The illusion persists because most people believe the spot price reflects reality. It doesn't. The spot price is a futures contract price paper trading paper. For every ounce of real silver, there are hundreds of paper claims. This allows unlimited supply to be created instantly. If a powerful entity wants the price lower, it doesn't need metal, it just needs balance sheet capacity. When these contracts are dumped during low liquidity hours, stop losses cascade, algorithms sell blindly, and the price collapses under its own mechanical weight. We've seen this before. In 1980, when the Hunt brothers accumulated massive amounts of physical silver, the system nearly broke. The response wasn't free market discipline, it was rule changes. Buying was restricted. Margin requirements were raised. Selling was forced. Silver collapsed, not because the fundamentals changed, but because the system protected itself. What happened overnight is the same event, modernized and automated. But today, there is a critical difference. The world is no longer unipolar. While Western markets suppress paper prices, physical silver flows east. China, India, and other emerging powers understand silver's strategic value. It is essential for modern civilization, energy, defense, electronics, medicine. Smashing the paper price, the West is effectively exporting real metal at a discount. Vaults drain in London and New York while inventories build elsewhere. This imbalance cannot last forever. The lower the price goes, the faster physical silver disappears. This creates a dangerous tension. At some point, an industrial buyer will demand delivery that cannot be met. When that happens, cash settlement replaces metal delivery and the illusion breaks. At that moment, the price on the screen becomes irrelevant. Value reasserts itself violently. This crash wasn't just financial, it was psychological. It was designed to humiliate, to exhaust, to convince holders they were wrong. This is the washout phase. Weak hands exit. Strong hands accumulate. This pattern repeats throughout history. The most explosive rallies are born from moments that feel like total defeat. Volatility is not the enemy of real assets. It is the signature of a broken monetary system struggling to hold control. Why does silver matter so much? Because it exposes debt. Governments drowning in obligations cannot allow honest price signals. Rising silver reflects declining trust in currency, threatens bond markets, interest rates, and ultimately state solvency. Suppressing silver buys time, but at an increasing cost. It's like holding a beach ball underwater. The pressure builds relentlessly. Meanwhile, industrial reality doesn't care about paper games. Silver is consumed, not hoarded. It's lost forever in products and landfills. Mining supply cannot respond quickly, and low prices discourage future production. This sets the stage for a supply shock of historic proportions. When industry is forced to compete with investors for dwindling ounces, price control ends instantly. What we are approaching is a separation between price and value. Paper silver and physical silver are becoming two different assets. Premiums rise as spot prices fall. Dealers disconnect. Delivery times stretch. This is how decoupling begins. When exchanges can no longer deliver, contracts will be settled in currency, and the truth will surface all at once. Silver has outlived every fiat system in history. Empires rise and fall, currencies come and go, but silver remains. This crash was not silver failing, it was the system revealing its fear. The lower silver is forced, the more unstable the structure above it becomes. This wasn't the end of the silver story, it was a test. A final transfer from the impatient to the prepared. From those who watch screens to those who understand history. The overnight massacre was not a warning about silver, it was a warning about everything else.